I believe we are live. Although it says we haven't gone live. Frank, can you hear me? Can you hear Jangle?
All right.
Okay, we are.
Sweet.
Hold on, Jangle. Let me get on the back channel so I can.
Welcome, everybody. Just give us a sec while we get everything set up.
Okay, so I guess people can hear me. Can you hear me, Jangle? You're muted.
Yep, I'm muting myself on the stream now. Yeah, I can hear you.
But you can hear me?
Yep. Let me listen in on the live stream and make sure everything
so
sounds
weird.
good.
So everything seems to be fine from my end, but I can't hear. Jangle can't hear me. I can hear Jangle. So it's kind of a weird. I don't know what's going on. Either way.
I think we found a workworkaround. So as long as everything sounds good to the viewer, everything is good enough for me.
Yeah, this is essentially, like we're doing some back channel communication so that Jangle can hear me fine. But welcome to the first episode of Beat the Banks Live from yieldfarming.com, the educational brand of Truffle Ventures. My name is Chris Soriano. I'm the Director of Client Success at yieldfarming.com. We also have Coach Jangle here. This is a regular thing that we normally do on our circle, which is beatthebanks.com. Not beatthebanks.com, that's not right. beatthebanks.circle.so. So feel free to join the PIG, the private investment group, and have fun along with us. There's more than, I believe, 9,000 people already in the community from all the trainings we've been doing for the entire year for the most part. And this is just something we've actually started to branch out and do here on YouTube Live. So we're excited to make this step into here. Jangle, if you want to introduce yourself a little bit more and just give a shout to anybody you want to, feel free to do so.
Yeah. Hey, what's up, everybody? I can see a few more people are filtering into the chat. I also am on YouTube with the chat, so you might see DeFi Jangle in chat every now and then, but I'll obviously be addressing most of your questions kind of on your screen live. But yeah, most of you who are here probably know me, tokenomics connoisseur, self-proclaimed ETH maxi. Want to talk about whatever crypto Web3 related stuff y'all want to talk about today. So I guess we'll be here for about an hour?
Yeah, roughly cool. About an hour. So let's go ahead and start with the big topic then, Jangle, before we kind of go into just talking about some general things. Then we'll also take questions. For anybody who has any questions, we'll certainly do that as well. Normally, these Friday shows are either normally an Ask Me Anything or a training of some type. We're also going to try and keep it light, maybe do a little bit of just basic Q&A or just have something fun for you guys. So let's talk about it. The Ethereum merge happened yesterday. It was roughly at about 2:30 a.m.
Yeah, Eastern time. For the Eastern time zone in the US. Mm-hmm.
I don't have the graphic. I wish I had the graphic of the pictures from the actual validator nodes, monitoring through their consoles where the proof of stake and the panda heads came up, showing that has activated. But what a moment in human history is what I told my wife. This is going to usher in a whole new era of different changes to crypto, some good and some, you can make the argument, some bad. Jangle and I were together as part of our Truffle Ventures Discord. It's our paid Discord for our paid mastermind. And I wanted to kind of get your vantage point, since you were live streaming the Ethereum Foundation's live stream on the matter. Tell me what your thoughts were going into that.
Yeah, so we did a Zoom call Wednesday during the day, I believe, where I went over a Substack article that I wrote and just some of my thoughts on potential security risks of a proof of work fork, but also what I was expecting for the merge in terms of volatility and the technical success of the merge. And outside of really everything but the immediate price action, nothing really could have gone better. So I outlined the other day how essentially we need the super majority of validators, at least 67%, to successfully upgrade and attest the blocks post merge. And I anticipated that we would get at least 90% due to a few weeks ago, the Bellatrix upgrade happened and we instantly got 95% of validators. So the validators were really ready for the upgrade. And we got about 95, 96% of validators that instantly upgraded to the merge on the appropriate block once the TTD was hit. So it was a resounding success. I think that there might have been some minor configuration issues with some minority clients on the network, but it was as successful as anyone could have hoped. It was the absolute best case scenario. So right after the merge, in terms of price action, we saw a little bit of a pump up to like 1650, but then obviously all risk on markets have been down. And I really just don't think that most of TradFi or institutional money it really understands the significance of the shift in monetary policy that this causes for Ethereum ETH, the asset. Obviously, it is a big deal for the kind of ESG narrative and for the energy consumption of a network in a time where energy prices are high and geopolitical tensions are also high with major global energy producers. So it's a really convenient time to kind of lower the carbon footprint, I suppose you could say, or the energy consumption of the Ethereum network. And the media and the mainstream media seems to be really latching onto that narrative. But I don't think they quite understand that this shift in consensus also causes about over a 90% reduction in Ethereum issuance. So we saw, if you go to ultrasound, I'll link it in chat here, ultrasound.money. We saw for a period of time that right after the merge, it was a deflationary network because there was essentially more ETH being burned than there was ETH being issued due to the issuance reduction of the merge, but also due to the fee burn that was added to the network about a year ago through EIP 1559. So between those two components and the elevated gas fees right after the merge, ETH was deflationary for a time being. Now we're at a slight, I believe it's about 0.1% inflation at these gas fees. So if we end up right now at current estimates, it's about 15 GWE average gas fees on Ethereum mainnet in order for ETH to be net zero inflation. That number can shift slightly up or down depending on a few other factors like the amount of ETH staked. But generally speaking, on average, right now, if ETH wants to be deflationary, then it's going to need to be about 15 GWE gas fees on average. So in these bear market conditions with the lower gas fees and the lower block space demand, we're probably realistically looking at a inflation rate for ETH asset dropping from about 4.3% to about 0.1%. And then as market conditions improve and the network gets more activity, it will shift towards more deflationary. So But right after the merge, we saw higher gas fees. And so if I go to ultrasound.money, we might be still negative, or nope, the supply increase since the merge is about 393 ETH. So yeah, it's a major reduction in issuance, a major step forward for the monetary policy, a major step forward for the security of the network, and obviously the narrative that is taking hold amongst the mainstream is the major step forward it is for the kind of energy consumption of the network. But price action doesn't necessarily one-to-one follow fundamentals in these markets. There are certainly market inefficiencies, but also all assets taking a beating due to the kind of anticipation of an increased cost of money, increased interest rates, and maybe more geopolitical uncertainty.
So Jangle, is it this positive number here for anybody who doesn't understand what this means? Is that a good thing, or because in the beginning it was negative? Do we want this to be positive or negative moving forward?
Yeah, so it is really a function of how much ETH is being burnt and how much ETH is being issued, right? So inflation or not inflation, we'll call it issuance, maybe not issuance either. The total amount of ETH, right, that gets added to the supply equals the amount issued minus the amount burnt. So the more ETH is burnt, the less inflationary it becomes. And actually, if enough ETH is burnt, then it becomes deflationary, right? And so that fee burn wasn't actually put into the network with the merge. That fee burn mechanism has actually been within the network for a little bit over a year now, since EIP 1559 in the latter half of 2021 that shipped. But what has changed with the merge is we've reduced the amount of ETH that is issued with every block, because staking is actually a lot cheaper than mining, doesn't require really hardly any electricity at all, much less hardware requirements. It's much more cost effective to stake than it is to mine. So the security budget essentially can safely drop. And so that security budget is coming from the issuance of blocks or of ETH in every block. And so since the amount of, remember that equation, the supply increase equals inflation or issuance minus the burn. So that burn has been there for about a year. And now we've taken that issuance part of that kind of algebraic equation and we've dropped it by 90%. So we've had deflationary blocks in Ethereum's history under proof of work. Like, for example, the most deflationary block so far has actually been the Other Side Land Mint from the Yuga Labs Other Side NFT project. That was like a crazy gas war. And so it caused tons of burning, which drastically overpowered. I mean, there was hundreds or perhaps thousands of ETH burnt per block in the blocks kind of surrounding that NFT mint. But now the issuance has dropped by such a significant amount, more and more blocks are going to be deflationary. And again, if that block is above 15 Gwei for the base fee for that block, it'll be a deflationary block, which 15 Gwei is not very much. Right now, we're at about 12 Gwei, 15 Gwei at this moment. So like these next blocks, we can see I've been talking for maybe 5 or 10 minutes, but the supply of ETH has only gone up by 3. So we've maybe had a block with a little bit of inflation, a block with some deflation, a block with a little bit of inflation. And so we're kind of really riding that line. So on that ultrasound money, if you go to simulate proof of work, if we were on POW, our supply increase would have been about 17,500 ETH in between the merge and now. But since we've dropped that issuance, it's only about 395. So again, if the gas fees go up, then the asset ETH becomes deflationary.
Cool. Thank you for that. So I wanted to bring up something really important before we move on. In the event that you have a Mac system, iOS, Mac OS, updated right now, there is a tweet from Wallet Guard. Let me see if I can find it. That specifically was outlining there's a vulnerability, first of all, that needs to be addressed. 1 second while I grab that link. There we go. I put it in the chat. Make sure you do that. Number one key that we teach at yieldfarming.com is to be safe and secure in your environment when you're doing crypto activities. That involves your browser, that involves having a clean device, that involves getting a hardware wallet to protect yourself with regards to just having a safe and secure crypto experience. So Wallet Guard is a fantastic Twitter account to follow. One thing I will tell you, if this is your first time here, we do believe that crypto Twitter is a fantastic source of information when it comes to crypto information. So we'll talk about that in just a little bit when we talk about curating your Twitter. Have a separate crypto Twitter to help train the algorithm to present information to you as a yield farmer, as a DeFi investor, in terms of just gaining the best edge possible. And that's all that a lot of this is about, just gaining that edge. So if you have not already, please update your iOS and macOS systems right now. This is easily exploded at the kernel level, meaning at the computer chip level. A very important update to do. So do that right away. Are you doing that right now, Jangle, on your MacBook?
Nah, I'm not too worried about it. So
no one's going to exploit me.
I'm joking. I'm joking. Yeah, update your stuff. I was wondering if you had seen any of the activity on GMX during the time surrounding the merge.
I have not. Do you have a screenshot or something that we can refer to?
Yeah, I threw it in YouTube chat, but also if you go to, I mean, you can look at stats.gmx.io, link that as well.
Let's look at that.
And yeah, and in my kind of tweet thread, right before the merge, I was looking at the open interest, and then Gabe actually pointed out as well that we were maxed out on the long capacity for GMX. So
that's right.
Due to how GMX actually functions, because there has to be liquidity to enable you to leverage trade on GMX. Like the only time I've ever seen any issues with the amount of liquidity being constrained is when people are trying to like leverage Link or Uni, since it's only like 1% of the GLP pool. It's lower amounts of liquidity, but I've never seen like ETH or BTC be maxed out in one way or the other. And so essentially, like, there are liquidity providers and they hold GLP. And they're basically the liquidity providers of the house. They get the fees from liquidations and just fees paid and trader losses, etc. And then there's the users who are kind of leverage trading and taking the other side of the trade. And they were skewed along to literally the max right before the merge. So there was about $37 million worth of short interest and over $101 million worth of long interest. And the ETH long capacity was maxed out at about 82.5 million. And as we know, there was a bump post-merge in the price, but it was pretty short-lived. And I don't know how many people actually ended up taking profits on that bump. But at the end of the day, it dropped pretty rapidly and wiped out a whole lot of GMX traders. If you scroll down to the cumulative, the trader's net profit and loss right there on the left. If you look at that big red, so traders on GMX lost about almost 3.7 million in one day. So if you look at the cumulative net loss of traders on GMX, it went from like 3 million to 6.5 million in a day, right? Isn't that insane? I mean, just look at that chart. It goes back months, right? And you can see the same thing. We had about like 3 million or something in trader profits, but then like 3 or 6.5 million of losses. And then if you scroll up all the way to the top, I think there's a fee chart as well up in the top right. Yeah, fees. So obviously I think this is cumulative, but if you go to the 14th, if you highlight over the 14th, that one was a pretty good day with a little bit over $1 million in fees generated. So GMX in about 24 hours made what, $4.5 million, right? Am I miscalculating that? Am I miscalculating that? So somebody probably can run the math on that. But on Wednesday, right? On Wednesday, the numbers for all the GMX fees that were, accumulated in the previous week get allocated to the rewards for the next week, right? So that was on Wednesday night, Thursday morning. I'm speaking in Eastern time in North America. And so all of those fees are like sitting in GMX right now, and they will begin to be distributed Wednesday, which is the 21st, right? So on Wednesday the 21st, the yield on GLP, well, granted, there have actually been a lot of folks who are probably anticipating this, and have the liquidity in GLP has actually increased quite a bit in the last 48 hours or so. But the yields on GLP and GMX should be quite substantial starting next Wednesday. And I would be surprised if, obviously everything really depends on macro more, and these are not necessarily like price predictions, not financialized and all that, but like the yields on GMX and GLP are about to moon on Wednesday. And probably like how many people are going to be able to anticipate that and like pay attention to like the week by week analytics on like how much revenue, fee revenue, and trading revenue GLP is bringing in and GMX is bringing in. I don't know. So I posted a few days ago about how I accumulated some more GLP or GMX with my ETH bag, kind of going into the merge as leverage beta. It's pretty much performed the same as ETH. It's pretty much been right on the performance of ETH since the merge, with a little bit of volatility that I've been taking advantage of in a V3 position on Uniswap. But I don't know. I think a lot of people are going to be taken off guard by how much yield is going to be on GMX and GLP, just like I was last Wednesday, when GLP this week has been over 35% paid out at ETH. So pretty impressive protocol. Traders just cannot seem to catch a break. They just keep getting wrecked, paying fees and losing money, which is okay, because as a GMX and a GLP holder, I'm okay with that. But yeah, very, very interesting. I just want to put that on everybody's radar.
Would you say that Arbitrum or Avalanche is the better play to make with regards to getting into GMX itself?
Oh yeah, I much prefer Arbitrum, just because I prefer ETH the asset to Avalanche, AVAX the asset.
Sorry, yeah. I muted the stream, but Jangle can still hear me in the background with my children. How funny. Anyway, we'll go ahead and move on. Let me bring that back out. A couple of things we wanted to talk about. And again, thank you so much for joining us. If this is your first time seeing us, this is probably the first time for everyone seeing us, but we represent a free community called Beat the Banks, and it's here across the ticker, across the bottom. There's more than 9,000 like-minded investors looking to get into decentralized finance, or possibly have been in DeFi for some time and are trying to find some of the best strategies around. Feel free to join our circle, which is a free community. We have fantastic free trainings that we have done over the last 6-7 months that are available to you for free. If you want to join our private mastermind, that's the Truffle Network. Feel free to also follow the links there to do that. You can also join us at yieldfarming.com, which is the original brand of Truffle Ventures, and join them, the many hundreds of people who have also joined and have found generational changing wealth through these fantastic strategies. Again, none of this is financial advice. This is all information for your personal entertainment. We're just two lovely people speaking to you through the computer screen into your internet. Moving on, I wanted to bring up something that we just had our investor-wide, our mastermind-wide talk, our regular Friday Q&A, and one of our fantastic members who is here in the chat, that's Susan, Wealthy Wise Woman, talked about a very interesting topic that, frankly, we just didn't really know a whole lot about. We didn't learn a whole lot about, but hadn't thought about. and that is Executive Order 14067. So we want to take a couple of minutes to kind of address what that is and find out more about it. I'll put a link to the actual order here in the chat, and that is the Ensuring Responsible Development of Digital Assets signed by President Biden back in March on Pi Day of all days. Wow, on Pi Day.
Yeah, this was interesting. I remember when this got signed, and I think it basically amounted to the president wanting some of the bureaucracy to essentially develop more of a concrete policy and a stance on digital assets and CBDCs, and maybe it gave them a like a time deadline or something like that. I haven't read through the whole thing, a lot of legal speak, but yeah, my 2 cents is essentially I view the Web3 and the crypto markets as kind of its own domestic native economy. So you've got, DeFi degens and NFT enjoyers and all this financial activity that's happening in this containerized network. And there's a lot of financial activity settled on Ethereum, layer 2s, alt L1s. And I think it's helpful to view the entire Web3 and crypto space as a fast emerging market. And what's interesting from like a policy perspective and from a regulator's perspective is that the kind of de facto medium of exchange and denominator of value, like unit of account, I think is the technical term that people will use. But it's dollars, and in some ways ETH, but typically like you'll measure an NFT in ETH, like, oh, it's worth 0.5 ETH or 3 ETH. But for a lot of things, you are like, if you're tracking the performance of your shitcoin, you might be tracking its performance against ETH, but like you're looking for it to 10x against the dollar, right? You're measuring a lot of things against the US dollar, and there's a lot of native liquidity pools with USDC and Tether and DAI and Frax and the dollar. So it's like the fastest growing emerging market in the world, where the base asset, the unit of account, is in a lot of ways ETH, but also in a lot of ways the dollar. So I think that intelligent policymakers will recognize that as maybe in some ways a threat, but in a lot of ways a humongous opportunity to have your currency controlled by your central bank be heavily adopted by the fastest growing emerging market in the world. What sort of authoritarian regime would not want that, right? Or a good-natured democracy or democratic republic, who wouldn't want their central bank to control the money and to have wider adoption of the dollar. So I think that from a game theory perspective, it makes the most sense to maybe have something like a USDC, which is not necessarily a central bank digital currency, but can really, on a moment's notice, with kind of no legislative action, be turned into a central bank digital currency, or have a lot of the same benefits, or drawbacks, depending on your perspective, have a lot of the same, ability for centralized control as a central bank digital currency. I mean, they're not going to be able to granularly control, what sort of things you spend USDC on, but they will be able to blacklist addresses, freeze certain funds, and that sort of thing. So I think it makes the most sense from a game theory perspective for the government to continue just to support USDC, to continue to kind of be antagonistic against Tether, and to have kind of a light touch regulatory approach until the industry kind of matures a little bit more and we get more direction. But the last kind of meaningful step forward in regulation was the Tornado Cash OFAC sanctions, which were certainly concerning, and we have that's going to court and lawsuits funded by Coinbase and Brian Armstrong, giving some pushback on that, and kind of code being protected by free speech. And but Tornado Cash is not going to be the only privacy tool. there are going to be in the future, once zero knowledge rollups really get off the ground, a lot of native execution environments and L2s where privacy is on by default. This is kind of the next, along with scaling, privacy and further decentralization are really high on the priority list of kind of the Ethereum community and the Ethereum Foundation. So, yeah, it's just like an interesting development. And as reading this executive order, I'll link it again. I know Chris already did. But if you want to check that out and read through it, just to see where the Biden administration is currently at, taking strong steps to reduce the risk that digital assets could pose to consumers, investors, and business protections, financial stability and financial system integrity, financial inclusion, equity, climate change, pollution. It's definitely an evolution and something to be mindful of, but I don't think any cause for panic just yet. But the analogy that I like that I didn't come up with, but it's the lifespan of a Thanksgiving turkey. Everything's fine until it's not. And so we kind of often say on crypto Twitter, people say the final boss for crypto is the regulator. So putting ourselves and putting the industry in a position where we take a lot of the tools of authoritarianism kind of away from the regulators. And so kind of having privacy native, privacy on by default, zero knowledge rollups, and DeFi infrastructure that doesn't have centralized points of failure, and maybe stablecoin issuers that are based off of decentralized collateral rather than U.S. treasuries. All of that is just important to keep in mind, and then vote with how you allocate your funds in DeFi towards the most decentralized projects, the most decentralized staking providers, et cetera. Is the best course of action you can take as an individual.
Do you know if Aave has unbanned all of the people who got that dusting? So basically someone went and Tornado Cash sent like 0.1 ETH to like everybody that was on that OFAC list, plus a whole bunch of different influencers, which caused Aave to actually ban them from using their service. Aave being one of the largest automated money makers
from their front end. So they host their own centralized front end. Yeah. So that's an important distinction to make. So if you don't have any development experience, somebody in the audience doesn't have any development experience, the contracts themselves, the actual smart contracts, live on the blockchain. So obviously different blockchains have different levels of decentralization, and you can write smart contracts in a way so that they are trustless, immutable, and decentralized or not, right? Different contracts are designed in different ways. And so you can't really make, smart contracts are decentralized as a general statement. But generally speaking, you can decentralize a blockchain, and you can write secure and trustless smart contracts on a decentralized blockchain like Ethereum, right? But then who has the knowledge and the capability of interacting directly with the blockchain? Not very many people, right? So then you need a website for people to go to, and they click a button, and that button actually communicates with what's called the back end, the blockchain itself, the smart contracts. And so those are two, what we call layers, right? You have the front end and the back end, right? In the front end, the websites are often just regular websites. There are ways to host decentralized front ends with protocols like IPFS, but it is not as common, right? And so especially for things like Uniswap and even Aave are some pretty good examples. They are decentralized smart contracts living on those blockchain networks that they're deployed on, but their front ends, their websites that you use typically to actually access those smart contracts are controlled and centralized front end websites. So when Tornado Cash was sanctioned, there was a troll or a activist, whatever you want to pose it as, who essentially took a bunch of ETH and sent 0.1 ETH through Tornado Cash and dusted a whole bunch of different wallets with it. And so many, Shaquille O'Neal and Anthony Sassano and I think like Mike Tyson, like anybody with an ENS name. Jimmy Fallon, I think, was one of the more popular ones too. Everybody you can think of that is kind of like predominant in the industry and has an ES name, their wallet interacted with Tornado Cash, even though they didn't approve it, right? It's basically a way to prove a point to the regulators, like, hey, you don't even know what you're doing. You have no idea how this technology works. And like, if you're going to have such like harsh, bureaucratic regulation that's not even really law, just like regulation that's just kind of willed into existence against open source code, like we're gonna dust everybody and everybody's going to jail, right? And so the front end websites and USDC in a lot of cases, even and a lot of the centralized exchanges who are forced to comply with this, but like notably, kind of for this conversation, Aave's front end blacklisting people wallets that had interacted with Tornado Cash, even if they were just dusted. So very importantly, anybody can stand up their own front ends and have the contract accessible through a different front end, or set up a decentralized front end through IPFS and interact with the contract. So the contracts themselves, if they are decentralized, if they are secure, if they are written correctly and they're immutable, then they're totally credibly neutral and user agnostic. But the front ends, often that is not the case. Very often that is not the case.
Thanks, sir. So before we move on, I wanted to ask two things. Jangle, what is that behind you? Is that a hanging piece of art that has wine corks in it?
Yeah, I am in an Airbnb, and so that was I haven't really contributed to this very much, but yeah, it is a collection of corks. Of corks.
It's pretty crazy.
Indeed. Yeah, I see a few questions in.
Yeah, we'll answer them, and we'll answer them in just a second.
Okay.
Before we do that, let's give a quick shout out to the mothership, which is Truffle Ventures. Yieldfarming.com is the DeFi education brand for Truffle Ventures. Our free goop based off of that is Beat the Banks. Feel free to join us at Beat the Banks at beatthebanks.circle.so. And one thing I wanted to talk about was we just released a brand new marketing video talking about Truffle Ventures and the idea of becoming a truffle pig and investing in truffle pigs and what that all means. It's a fantastic video that we've put together. It's roughly about 20 minutes. So if you have a minute to check it out, if you're an accredited investor or know somebody who is an accredited investor, feel free to check this out. It's hard capped at 400 seats. It's honestly going to be probably, if you're asking me as an accredited investor, probably the sickest offer ever in crypto investing. So if you know anybody who's in that, if you're a representative for someone who is an accredited investor, show them that video. If they're interested, feel free to reach out, let us know. Moving on, before we go to Q&A, I did want to bring about a little bit of training. Not too much training, just a little bit of training on this first episode of Beat the Banks Live. We're going to talk about becoming your own truffle pig. What does that mean? Basically, in our world, a truffle is an unbelievable piece of alpha, is another word we call it, intelligence. You can call it insider information. The best deals to get in early in DeFi is that's the premium. You want to get in early on as many crypto type of projects that you can, because the earlier you are, the better off you'll be position-wise. That's a given, right? So when we talk about becoming a successful yield farmer, when you sign up for our private mastermind, we have 3 basic phases when you're learning to become a yield farmer. It's first getting set up, security, getting a hardware wallet, setting up that first farm. Level 2 is setting up more yield farms, creating what we call an all-weather portfolio, and also an effective yield farming routine, which I've done a training on this in Beat the Banks. It should be there under the free trainings. And then the third part is just optimizing, understanding what we call Dior, or doing your own research. And basically what that means is 3 things. First, you have to craft your investment thesis, whether that be a bear thesis, a bull thesis, a base thesis, whatever that may be. You want to make sure that you have a plan, that you have a mindset that you're going to maintain throughout this whole process. Now, The key to this, once you've created that thesis, is then going out and finding alpha. And when you're finding alpha, it's all about curating your alpha sources. For us, we have our own alpha tracker. I'm going to release, actually, for Beat the Banks, a list of Twitter accounts you should follow. Just literally add that list to your crypto Twitter. You'll get a whole bunch of awesome sources coming out into your feed. And also doing it yourself, curating as you find really great alpha that's out there. And that's the easiest way. Once you find someone that is a really good influencer or has great calls, has great information, once you follow them, often Twitter will try and recommend more people to you. This is the same for any social media that's out there if you use it for crypto type of activity, whether that be TikTok, which we call FinTalk, YouTube, Facebook, Instagram. All of these have algorithms that you can train and curate to really harness and leverage the information that's coming to you. Now, the key with alpha is filtering out all the noise, because frankly, a whole bunch of it out there is just crap. And you want to make sure that filtering out alpha is a skill that you have to build and master. Now, some of these don't apply to you all here, so I apologize. This is from information I had with my level 3 cohort last evening. But understanding how to filter and apply that alpha is supremely important. And a lot of that comes with understanding what your investment thesis is. If you're a risky person, if you're a risk averse person, rather, you're not going to go out and invest in alpha for like the last 3 dozen Queen Elizabeth coins that just deployed over the last week. That's not going to be for you. You're looking to look for people who have great yields that are safe, not a whole lot of leverage, stable coins, stable farming, finding really sound investments with with strong fundamentals, tokenomics, and first principles. Again, this is all stuff that we cover in our trainings. The other part of it is understanding how to craft that thesis along with allocation management. Now, if you followed our trainings, you know that we talk about the 40-40-20, meaning 40% in long-held assets that you'll hold for at least 1 to 3 years, 40% in market neutral or stablecoin yields. That's going to be the engine that drives revenue back to getting that more of those blue chips that you're looking to stack, whether it be Bitcoin or Ethereum or anything else you have super high conviction in. That's up to you to figure out what that is. And then the 20% is going to be based on medium and high risk. So that could be certainly anything like Dogecoin. If you want Dogecoin or SHIB, go out and get it. Just don't risk the entire allocation on it. It doesn't make any sense to do that. In fact, I wouldn't even spend more than 2 to 5% of your allocation on that, because the key is you want to be able to stack those blue chips right now, especially right now where we're a little bit in this bearish bottom kind of area, stacking all those chips so when the market explodes, you are ahead of everyone else that just kind of left DeFi thinking DeFi was dry. Because as we say here, bull markets make people rich, bear markets make people wealthy. And we're all about making people wealthy. We don't want anyone to lose money. So crafting entrance and exit strategies based on how you want to enter the protocol. That's all about, curating that list. And again, this is a very quick overview. We can certainly go into depth of this on another future training, specifically how we do our research finding and, how we apply that. Understanding what tokenomics are. Jangle has a fantastic training on tokenomics and stablecoins that he's already done. That's in our free training. That's over there at beatthebanks.circle.so. Sorry to be a broken record about it, but we've got some of the best information on the entire internet in DeFi. We've got the world-class team. So don't just ask us. Ask people here in the comments. So many people from banks are a part of our mastermind and just killing it. Totally stacking, having a fantastic time. Really just gaining the right information. And that's the key, right? It's all about what you invest in. Investing in education to make sure you're doing the right things is super important. So that's all I'm really going to say on that. We'll get back to the rest of the stuff because we're kind of running low on time. So
yeah, there's a lot of great questions in chat I really want to get to.
Let's
one of them
do that.
earlier was Adrian asked why there are no major Euro stablecoins. There actually are some. I think Tether has a Euro stablecoin, and then Circle announced one not too long ago as well. They just haven't gotten the same amount of adoption, probably because why would you hold the Euro when you can hold the dollar? Because there is essentially zero friction in swapping from one digital asset to the other. And this kind of goes around to why I'm So bullish on competent regulators supporting crypto innovation in America, because it is a tool to increase dollar dominance across the globe, right? If you give somebody the option to hold dollars, they will likely take it over any other fiat besides maybe the ruble. The ruble, the Russian ruble, is the only fiat that has not been down only against the dollar over the last 6 months. In fact, I think year to date, the ruble has outperformed the dollar, and the dollar has outperformed everything else by a very significant amount. So like if you were holding the dollar, you're up like 20%, I think, or 25% year to date against the euro. So even if you're getting, 4%, 8% yields being in a dollar euro stablecoin pool, you are going to be getting wrecked by impermanent loss, and you're going to underperform just holding the dollar, and especially like farming in just dollar stablecoin pools. But great question. Yeah, Steve, there is a euro stablecoin now, and it's just not very popular because most people in crypto prefer to hold, ETH, Bitcoin, or dollars, or shitcoin.
Let me look at a different question here, and let me know, Jangle, if there's one that you want. We'll go ahead and put it up here on the screen. Let's go with Steve McGarrett's question: is all weather, does that equal hedging positions?
Yeah, it can be, I suppose. I think of my cash position as a hedge against risk, right? Because I spend my expenses in dollars, so that's what I really need to be able to weather risk for long periods of time, and it's what I need to essentially capitalize the most on market capitulation events and pain within the market. So yeah, I don't typically keep a lot of really active short positions open. Some people do enjoy the strategy of shorting altcoins that have really inflationary tokenomics, really high fully diluted values, and really relative to their current market caps. And I think that's a good strategy. Oftentimes I'll use on-chain money markets like Aave to take slight leverage or hedge positions. So if you think about it, let's say you want to accumulate ETH and you're bullish on ETH, and you're maybe not as bullish on Alt L1 trades like something like AVAX or Phantom, and maybe you're more bullish on ETH than Bitcoin. So if you want to provide ETH as collateral and then borrow some AVAX, some Bitcoin, and some stable coins, and then sell those off or sell the AVAX and the Bitcoin off for stable coins, then it's a way to reduce the volatility of your portfolio. And then you can go farm with those stable coins elsewhere, or trade them for a position like GLP that I talked about earlier, which is a Bitcoin, ETH, and stablecoin position that's like really high yield. So there's a lot of ways to construct it. When I think of an all-weather portfolio, I think of one that captures the long-term upside of the blue chips like Bitcoin and ETH, for me, primarily ETH, while also generating a lot of yield through LP positions and positions within DeFi, and something that has a lot of stablecoin allocation or reasonable stablecoin allocation to where I can reduce my overall portfolio volatility, capitalize on capitulation events, and maximize my sleep-adjusted returns.
I like that, sleep-adjusted returns.
And that's a Taiki classic.
That's a Taiki classic. Nice.
Yeah.
Fair enough. Being a humble farmer. Shout out to Taiki Maeda, well-known YouTuber in this space. To also that, when we mention the all-weather portfolio, it's really just the idea that you can take your allocation once you've built your allocation, and then trying to figure out, do you like the way that portfolio looks now? How would you feel about it if the market were to drop 50%? And then look at it again if it were to drop another 90%. Do you still like your allocation? If so, then your portfolio is all weather, meaning you can specifically brace yourself against all kinds of market conditions. So yeah, in general, yes, hedging positions can certainly be part of that all-weather portfolio. Oftentimes, we do lump in delta neutral positions into that middle 40% with stablecoin and market neutral yields. That's what that market neutral yields piece stands for. So ultimately, yeah, if you can find a good hedge, whether if you're just literally just borrowing some ETH at Aave or some other lending AMM, or providing some other type of position to balance out whatever other staking positions or LPs that you have your liquidity in, then certainly you can count that as part of just being all weather, because you want to make sure you have that upside against your long. Keep yourself completely balanced. Okay, let's see what other questions we have. This one is from the Susanator. How do you feel about Redacted Cartel and their projects Hidden Hand and Pyrex?
Yeah, so every Wednesday I have a call with our Truffle Network members, and I usually go about an hour and a half about projects I'm interested in, a deep dive on them, as well as like market movements and fundamentals updates and analysis of different on-chain activities, etc. So I covered this about a week and a half ago, and the projects Hidden Hand especially, I'm very interested in monitoring that. As a lot of people know, I'm really deep into what's called VE tokenomics, and that was popularized by Curve. But now a lot of other projects are using these VE tokenomics, which involves using your tokens, your locked tokens, to allocate future potential rewards, which is worth a monetary price or monetary premiums associated with this. So there is a what's called incentivized voting, a nicer way to say bribes of token holders. And so you have traditionally the Vodium platform that handled bribes for Convex, and Hidden Hand is with Aura and Balancer, and I believe VE Frax as well, and just other VE tokens within the DeFi space, mostly on Ethereum mainnet. And they take about a 4% fee for providing this kind of Vodium-like service, but for all these other VE tokens where you can basically allocate your votes to Hidden Hand, and they will get you the best bribes on your VE tokens, and they take a 4% fee in order to do so. 2% of that fee goes to the butterfly stakers, 2% goes back into the Redacted Cartel treasury. So basically, the butterfly holders have three sources of revenue. One is the yield that the Redacted Cartel treasury generates, and it's growing all the time through Hidden Hand and Pyrex. Two is Hidden Hand, the 2% of all the volume that goes through Hidden Hand. And three is Pyrex. And Pyrex basically allows you to take your vote locked Convex and make it liquid. So it's the more esoteric and strange, more difficult to understand products of the kind of Redacted Cartel suite of products. Very interesting stuff. Very good value accrual mechanics to the token. And they actually kind of launched originally with kind of the Ohm bonding model, and that's how they bootstrapped their original treasury. But they have shifted their tokenomics, I believe, to a V2 tokenomics type model, and they have a inflation schedule that is better than it was, but it is still quite inflationary. Let me see if I have the tokenomics saved. I don't think I can find the bookmark right here, but sorry, I can maybe check my slide deck from before and it'll be on there. But essentially my thoughts are value accrual is very strong, treasury yield very attractive. If they're trading close to treasury value, that would be or especially below treasury value, that would be good, and something I'd maybe consider allocating to. But at least for the next 6 months, the emissions really are still quite high. So especially kind of in these market conditions, it's not something that I'm rushing to buy right now, but the butterfly token is for sure on my watch list. And the other key kind of metrics I will be watching are the adoption of Hidden Hand and the adoption of Pyrex, and especially the amount of volume bribe volume that Hidden Hand does, because the more bribe volume Hidden Hand does, the more bribe volume that goes through Aura and Balancer and other VE tokens that are hidden in the Hidden Hand kind of product line, the more revenue that the Butterfly token will generate. I believe the annualized revenue is around like 10% or something right now yield, and maybe the prices drop, so maybe it's a little bit closer to like 15% since the last time I checked. But yeah, very interesting project, strong token, strong products that they're launching. So they don't just have the treasury and the treasury yield, but they're also launching things like Hidden Hand and Pyrex that are going to generate kind of real revenue on top of their organic treasury yields. The only kind of linchpin in the whole thing, the only issue that I see as a reason to be very tentative about potential allocations for the next like 6 months to 9 months, especially, is the inflation of the token itself. So the fully diluted value, I think, is sitting at around 200 million, which is, I think, not cheap. And so I like to buy things that are at a discount. So I'm going to wait until the fully diluted value is around treasury value, or if it is 50%, 30% above treasury value, it is because the Hidden Hand and the Pyrex, especially Hidden Hand, I'm more interested in. I think it's going to drive more revenue. Is just exploding in volume, VE tokenomics getting more popular. And I also consider, what are the moat for these products like Hidden Hand and Pyrex? And really, Hidden Hand really only has competition with Vodium, but that's with CVX. And there's nobody else really doing what Hidden Hand is aiming to do. So I think that it does have somewhat of a defensible moat. And so those are the things I'm looking at. Don't have any allocations now, and we'll be keeping an eye on it though.
What about projects like Concentrator, Jangle, and other major ecosystems that have vested equity or vote escrow tokens like this?
Yeah. So Concentrator is the reason why I like Concentrator a lot is because, one, mainnet is a gas intensive chain to operate on, and there is demand for a curve auto compounder that takes advantage of convex boosts. And so that's what Concentrator does. It allows you as a liquidity provider to take advantage of convex boosted yields in a very gas efficient way. And so that's good. And another thing is that they can bring curve yields multi-chain and Frax yields, FXS yields multi-chain. Right now, if you're holding curve CRV on Polygon, then you can't stake it. You can't really get the convex curve yields or turn it into VE curve and get your revenue share. You're kind of just out of luck. So if they bring and get increased adoption for their ACRV and their, I think they call it AFXS multi-chain, then that would be great for users who are holding curve or who might hold Frax FXS, that is, on other chains. And they would be able to get those yields, and their auto compounders for those are based on the CVX CRV pool and the FXS CVX FXS pool. So bringing those kind of auto compounded curve and Frax yields to other chains for a fee, I think is a very profitable model as well. So that's what I'm looking at, is like, okay, what are the protocols that are gaining adoption, and who's building the picks and shovels in the critical infrastructure? And then, like, how can I acquire those tokens when they are like maximum discount so I can get the most possible cash flow with my purchase, is how I like to think about it. So really a big fan of Concentrator. Their tokenomics are a lot more sound with a max supply after their initial farm offering. I actually wrote a Substack article for Concentrator and how their initial farm offering works. So if you're interested in that, I'll link it right there. I don't know why that link looks so weird, but it should work. And yeah, so I think it's a good project. Very interesting.
Thanks, James. I went ahead and posted our free training post link One thing I'll also post a link to, and this is again in Beat the Banks, which is at beatthebanks.circle.so. Let me get that ticker back up and going. And one thing that we also have is a series that Jangle and I did called The Fundamentals of DeFi. And this is meant to be a series you would watch, just 3 30-minute episodes that we filmed back when we both had different hair. And it was, it's basically meant to be concepts that come before yield farming. So understanding what is a centralized exchange, what is Jangle's snake meme or vending machine analogy that he uses to describe blockchains and things like that. It's really just a good way to get yourself a nice foundation with regards to understanding how to get into DeFi. Ultimately, you know, and I answered this question for I had a plumber here who was curious because he saw my hoodie because it has multiple coins on it, and he was wondering if I was into crypto. So I kind of course, had to describe what I do. But essentially, the idea is that, you know, decentralized finance is a level deeper than regular centralized finance. So if you go to a regular centralized exchange and CeFi or centralized finance, we have, you know, sites like Binance and Coinbase, FTX, Crypto.com. Those are, you know, custodial entities where you can purchase assets and to a degree have a cash position on most of them. But most of them allow you to take custody of those assets if you'd like and withdraw them down into decentralized finance. And what decentralized finance is just a network mesh of computers where not one entity owns everything and you are in custody of your own assets on the blockchain, which is why we say you're your own bank. That's why we say beat the banks with this group, working to beat that 0.1% APR you get on that savings account at your bank. We can regularly beat that and regularly beat the market, you know, with the stock market at, you know, 7 to 10% on a really great average. We can certainly beat that as well with a lot of the great safe and secure type of investments that we have here in decentralized finance, which has completely transformed itself in the last year, I'd say, from just being a place where you would go to Pancake Swap and, you know, pop money into weird little farms with jumping frogs and bears and whatever other animals that you can think of, to now being full-fledged financial entities that provide lending, savings, and loan. At some point, there's going to be they're working on a private blockchain with private data. So then suddenly real estate, insurance, medical, all of this stuff is coming into Web3, which is what this whole, I guess, bubble is, to the point where this is going to be the future of how you do business. At some point, there's going to be an easier way to do this where you don't need a web browser, because that seems to be a little bit of a crutch for a lot of people, but it's a necessary transition along with even some of these CBDCs. These will be transitions that we will need to get into the point where crypto can successfully decouple itself from a lot of different links that it has to traditional finance. So ultimately, that is what we are looking to help you understand, empower you to learn, and figure out for yourself. That's exactly what we're here to do. So
Man, we're covering the gambit today. We're going from, you know,
we
what
sure
is
are.
self-custody and DeFi and executive orders and regulation, GMX analytics, and then what is, you know, concentrator VE tokenomics and the butterfly redacted cartel, and covering a little bit of something for everybody. A little bit of
I
something
think
for
so.
everybody.
I think so. So Jangle, let's leave with this. Give me 2 protocols or blockchains that you're super excited about right now.
Arbitrum, I think, is the place to be. Arbitrum Odyssey is probably going to ship soon. Really excited for the Curve stablecoin, and to see what that, you know, design and mechanism is. And just still very excited for GMX, getting better at Uniswap v3, and you know, if I was really new to DeFi, I would check out our free trainings on Beat the Banks and just kind of slam through those. You know, everything from self custody and using a hardware wallet to understanding tokenomics, and even concentrated liquidity farming. It's all there. So just work through it, and then make posts and engage, because we've kind of been in a transitional period where we've been moving these free trainings from Zoom to now on here. So we've kind of had a little bit of a lull in Beat the Banks for the last few weeks. So post and engage because that way, it'll prompt us to essentially learn more or teach you more and contribute more to that platform. So expect these live streams fairly regularly. Make sure you subscribe. We've got 28 people in the stream right now and about 15 likes. So if we could just improve that ratio, that would make a lot of sense. I think we could really do a little bit better than that.
We'll up the marketing budget.
make sure you subscribe and turn your notifications on. And if you're in Beat the Banks, we'll announce these live streams. And so you'll know whenever we're live on here. But yeah, this is probably where most of our future trainings are going to be. Look at that, 20 already. Can we get it to 25? 20. Okay. All right. If we can get it to 25, I'll be happy and I'll be able to sleep tonight. But yeah, thanks for being here, everybody. None of this is like an endorsement of any particular token or any particular project. I don't know what the market's going to do for the next few weeks. And anybody who says they do with any high degree of certainty is lying. But I know that as some people say, we're headed west. And there's a lot of opportunity. So make sure you are protecting yourself. You're using a hardware wallet. You're not giving away your seed phrase. You're not buying shitty altcoins. And I appreciate everybody for coming here and spending some of their Friday with us. And that's all I got to say.
Well, I was going to give my picks before you started doing the outro and everything. My goodness.
Go ahead.
Of course, like and subscribe, of course. We'll continue to doing this. And obviously, if you have a minute, feel free to follow us on the tweeters. We would greatly appreciate that. Let me get our handles out there. There's our handles.
Mine and
feel free to follow us on Twitter. Be happy to do that. I actually have some giveaways to do from our live stream on merch day, right? So I need to do that, which will include many of you that are already here. So I'll give me the time to do that. It's been a little busy past couple of days. With regards to my pick right now, overall, most of my bag is in Kujira, which is a blockchain on the Cosmos ecosystem. They were a former project on the Terra blockchain. They were a liquidations house through a protocol called Orca. So basically, if you're on Anchor Finance or Mara.finance, you would be able to stake both ETH and Luna, and at some point it became Atom and AVAX as well. And anytime someone got liquidated, it would come over to Orca, and you can bid and get any of those assets super cheap. And I think that's a very necessary, specific type of business that we need in DeFi. GMX has a liquidations protocol. Obviously, people use GMX for both longing, shorting, and leverage trades. Yeah, and that's where most of your liquidity as a GLP holder goes into fueling that. So that's why you get rewarded with that. So same thing with Kujira, fantastic Cosmos blockchain that is providing that liquidations house as well as a decentralized order book with their Fin system, and then they're staking with Blue. They've turned a protocol into an entire blockchain, and that's the one thing about the Cosmos ecosystem is that most of these blockchains, and there's well over 50 of them at least, are all application chains as well, meaning that they can use the services from one blockchain and use it at other partner blockchains in Cosmos as well. So they're rolling out their new interchain security system very soon, along with Osmosis, the main decentralized exchange blockchain, their app chain. They're going to be coming out with concentrated liquidity as well. So big moves. That's my biggest one. The other one is going to be jopegs.com. I'm going to do a training on NFTs for anybody who's interested. We'll do a live stream on it most likely next week, so you can kind of see what I've been doing. I call it my death spiral into madness, but I've been able to find some interesting gems. NFTs can definitely be quite the ROI experience. A lot of people think that it's all about pictures, but a lot of the projects I've been looking into actually have a lot of utility towards it, as well as being able to stake NFTs, augment them, and gain a lot of ROI on the back end based off of that. So We'll try and do that next week. And yes, if you didn't get your free merge NFT, do that at gosh, I don't have a link for you. Jangle, do you have a link for the POAPs for consensus that have those? If you
Yeah, the consensus one, and let's see. Yeah, I do, and I'll tweet about all the POAPs and
there we go.
NFTs commemorating the merge here in a second. So if you follow me on Twitter in the next hour or so, I'll aggregate them all into one
Perfect.
thread. Yeah.
And I'm going to be making I'll be making I'll comment, I guess, on this live stream with the list that you can add to get a whole bunch of great Twitter authors with regards to crypto into your feed, so you can start curating your own list and become your own truffle pig. So, with that said, again, we know you have your choice in learning where to get your information in DeFi. We're so happy you're here joining us today. Beat the Banks, presented by yieldfarming.com, the DeFi education brand from Truffle Ventures. I'm Coach Chris. This is Coach Jangle. We thank you so much for being here with us. Have a great weekend. Keep beating those banks. Keep getting those gains. Find those truffles. Oink, oink, everybody. Have a great day.
Thanks, everyone. Bye.
See ya.